Financial Markets and the Business Cycle, Chapter 2. Introduction. Our principal objective here is to explain the benefits of the technical approach, but it is also important to understand that primary trends of stock, bonds, and commodities are determined by the attitude of investors towards unfolding events in the business cycle. Each market has a tendency to peak and trough at different points during the cycle in a consistent chronological manner. An understanding of the interrelationship of credit, equity, and commodity markets provide a useful framework for identifying major reversals in each. The discounting mechanism of financial markets. The primary trend of all financial markets is essentially determined by investors' expectations of movements in the economy, the effect those changes are likely to have on the price of the asset in which a specific financial market deals, and the psychological attitude of investors to these fundamental factors. Market participants typically anticipate future economic and financial developments and take action by buying or selling the appropriate assets, with the result that the market normally reaches a major turning point well ahead of the actual development. So, the market normally reaches a major turning point well ahead of the actual development. Okay. Expectations of an expanding level of economic activity are usually favorable for stock prices. Anticipation of a weak economy is bullish. Figure 2.1, the idealized business cycle. So, anticipation of a weak economy is bullish for bond prices, and prospects for capacity constraints offer a favorable tailwind for industrial commodity prices. These three markets often move in directions simultaneously because they are discounting different things. An economy is really stable. Generally, it is either expanding or contracting. As a result, financial markets are in a continual state of flux. A hypothetical economy, as shown in Figure 2.1, revolves around a point of balance known as equilibrium. Roughly speaking, equilibrium can be thought of as a period of zero growth in which business activity is neither expanding nor contracting. In practice, this state of affairs is rarely, if ever, attained since the economy as a whole possesses tremendous momentum in either the expansionary or the contractionary phase, so that the turnaround really occurs at an equilibrium level. In any event, the economy consists of a host of individual sectors, many of which are operating in different directions at the same time. Thus, at the beginning of a business cycle, leading economic indicators such as housing starts might be rising, while lagging indicators such as capital spending could be falling. Major technical principle. The business cycle is nothing less than a set of series of chronological events that are continually repeating. Market participants in financial markets are not concerned with the periods of extended stability or equilibrium, for such environments do not produce volatile price swings and opportunities to make quick profits. The ever changing character of the economic cycle creates tremendous opportunities for investors and traders because it means that different industries are experiencing different economic conditions simultaneously. Since housing leads to the since housing leads the economy, since housing leads the economy, housing stocks do well at the start of the recovery when capital intensive stocks such as steels tend to underperform. Later in the cycle, the tables are turned and housing peaks first, usually in an absolute sense, but occasionally as measured by its relative performance to a market average, such as S&P Composite. Different equity sectors discounting their specific area of the economy gives rise to the sector rotation process, which is discussed at length in Chapter 22. Since the financial market leads the economy, it follows that the greatest profits can be made just before the point of maximum economic distortion or disequilibrium. Once investors realize that an economy is changing direction and returning toward the equilibrium level, they discount this development by buying or selling the appropriate asset. Once investors realize that the economy is changing direction and returning toward the equilibrium level, they discount this development by buying or selling the appropriate asset. Obviously, the more dislocated and volatile an economy becomes, the greater is the potential not only for the return toward the equilibrium level, but also for a strong swing well beyond it to the other extreme. Under such conditions, the possibility for making money in financial markets are greater because they too will normally become subject to wider price fluctuations. Two of the wildest post World War II economic swings, 1973 to 74 and 2007 to 2008, certainly provided traders and investors with a roller coaster ride with greater profit possibilities. With great profit possibilities, were they able to identify the two respective bear market lows, market movements, and the business cycle. The major movements of interest rates, equity, and commodity prices are related to changes in the level of business activity. Please note that the term commodity refers to industrial prices that are sensitive to business conditions, as opposed to weather-driven commodities such as grains. Figure 2.2 represents the business cycle, which typically has a life of between 3 and 5 years between throws. The horizontal line reflects a level of zero growth, above which are periods of expansion and below which are periods of contraction. After the peak is experienced, the economy continues to grow, but at a declining rate, until the line crosses below the equilibrium level and contraction and economy takes place. The arrows in figure 2.2 shows the idealized peaks and troughs of the financial markets as they relate to the business cycle. Figure 2.2, the idealized business cycle and financial market turning point. B is equal to bonds, S is equal to stocks, and C is equal to commodities. Periods of expansion generally last longer than periods of contraction because it takes longer to build something up than to tear it down. For this reason, bull markets for equities generally last longer than bear markets do. The same could be said for interest rates and commodities, but in all cases, the magnitude and duration of primary trends depend on the direction of secular trend, as discussed in chapters 1 and 23. Figure 2.3 shows the hypothetical trajectories of bond prices, commodities, and equities during the course of a typical business cycle. Figure 2.3, idealized sine curves for the three financial markets. Referring back to figure 2.2, we can see that the bond market is the first financial market to begin a bull phase. This usually occurs after the growth rate in the economy has slowed down considerably from its peak rate and quite often is delayed until the initial stages of recession. Generally speaking, the sharper the economic contraction, the greater the potential for a rise in bond prices will be. That is, a fall in interest rates. Generally speaking, the sharper the economic contraction, the greater the potential for a rise in bond prices will be. That is, a fall in the interest rates. Alternatively, the stronger the period of expansion, the smaller the amount of economic and financial slack, and the greater the potential for a decline in bond prices and a rise in interest rates. Following the bear market low in bond prices, economic activity begins to contract more sharply. At this point, participants in the equity markets are able to look through the trend of deterioration in corporate profits, which are now declining sharply because of the recession, and to begin accumulating stocks. Generally speaking, the longer the lead between the low in bonds and that of stocks, the greater the potential for stock market to rally. This is because the lag implies a particularly deep recession in which extreme corporate belt tightening is able to drop break even levels to a very low level. During the recovery, increases in revenues are therefore able to quickly move to the bottom line. Generally speaking, the longer the lead between the low in bonds and that of stocks, the greater the potential for the stock market to rally. This is because the lag implies a particularly deep recession in which the extreme corporate belt tightening is able to drop break-even levels to a very low level. During the recovery, increases in revenue are therefore able to quickly move to the bottom line. Quickly move to the bottom line. After the recovery has been underway for some time, capacity starts to tighten, resource based companies feel some pricing power return, and commodity prices bottom. Occasionally, after a commodity boom of unusual magnitude, industrial commodity prices bottom out during the recession as a result of severe margin liquidation due to excessive speculation during the previous boom. However, this low is often subsequently tested with a sustainable rally only beginning after the recovery has been underway for a few months. At this point, all three financial markets are in a rising trend. Gradually, the economic and financial slack that developed as a result of the recession is substantially absorbed, putting upward pressure on the price of credit, that is the interest rates. Since rising interest rates mean falling bond prices, the bond market speak out and begins its bear phase. Because some excess plant and labor capacity still exists, rising business activity result in improved productivity and a continued positive outlook. The stock market discounts trends in corporate profits, so it remains in an uptrend until investors sense that the economy is becoming overheated and the potential for an improvement in profits is very low. At this point, there is less reason to hold equities and that in turn enter into a bear phase. Later on, the rise in interest rates takes its toll on the economy and commodity prices begins to slip. Once this juncture has been reached, all three financial markets begin to fall. They will continue to decline until the credit markets bottom. This final stage, which develops around the same time as the beginning of the recession, is usually associated with a free fall in prices in at least one of the financial markets. If a panic is to develop, this is one of the most likely points for it to take place.